So now we're going to talk to you about the third section of this module, which is around capitalization of borrowing cost and disclosure requirements. So up till now, we've talked about many things around Ind AS 23 when it matters to borrowing cost. So we try to understood that what is borrowing cost, when do you start doing the capitalization, what's the distinction between general borrowing and specific borrowing, and how we also understood the whole concept of that the money is fungible, right? And at length we discussed the accounting nuance, what you need to look at if you've actually borrowed money in foreign currency and not in your functional currency, and then how the difference between the interest rate if you were to borrow money in a foreign currency versus functional currency, and how the exchange rate losses if you have incurred on account of your liability translation or revaluation losses, how you can actually consider some of those losses for the purpose of capitalization. So we have discussed all of that at great length, and we picked up many examples. Now I'm going to talk to you about commencement of capitalization, as to from which date you actually start doing the capitalization of your interest cost. And let's say if there is and there is a problem in terms of your project which was going on, there was abnormal stoppage of that project, then do you really need to stop doing the capitalization of interest, or you actually continue with the capitalization of your interest cost? So that's an important learning which we need to have as we look at kind of this section on borrowing costs, a very very important principle, and we will talk about all of that. So as we look at the commencement of capitalization, it should commence at the earliest when all of the following are met. So again, remember that the application of the standard is mandatory. It's the capitalization of interest is not an accounting policy choice. So if you are running a qualifying asset, and remember we talked about the qualifying asset, something which takes more than 12 months in general, though that's an area of judgment, but something which takes more than 12 months in terms of to build and your ability to operate, uh, and that is where that's a qualifying asset. So if you have a qualifying asset on the right hand side of your balance sheet, and if you have an interest cost which you're incurring on your liabilities on the left hand side of your balance sheet, then that interest cost is something which you need to evaluate for the purpose of capitalization, and it is not an accounting policy choice, it's mandatory, right? So capitalization should commence when you've started incurring the expenditure for the asset, right? So the asset which you are trying to building up. So for example, if I'm doing a construction of a factory building, I'm doing construction of a large plant and machinery, like let's say I'm building a power plant, or I'm building a cement plant, or I'm doing my office building, etc. So whatever asset which you are building upon is what you need to appropriately consider for the purpose of capitalization. So is there expense you have started incurring? Are you incurring the borrowing cost? So have you started spending money on account of interest, right? So you in general, you are not supposed to start capitalizing unless you have an interest expense in your P&L. So you need to have or interest expense in relation to your liabilities. So as borrowing costs are being incurred, have you started doing activities to prepare the assets for its intended use or sale is in progress, right? So expenditure is being incurred in relation to the asset, the interest cost is also being incurred, and you started working in a way so that the asset is actually moving in the direction for which it is designed, for the purpose for you to use it in your business deployment, right? So that you can generate probable future economic benefit. So you got to look at expenditure, you got to look at the cost of the borrowing, and the activities to prepare the asset for intended use or sale is in progress. So now I am going to look at this example. Ozone Limited, an equipment manufacturer, is starting construction of a new plant to be financed by a term loan from Big Bank Limited. Okay, Big Bank. Mentioned are the relevant dates. May 15, 2019, Ozone Limited starts incurring interest expense on the loan. June June 2, 2019, commencement of technical site planning. Okay. June 19, 2019, commencement of expenditure on the project. All right. The commencement date is when all three conditions have been satisfied is later basically, which is June 19, 2019 in our example, right? Let's talk about suspension of capitalization. So you were doing a construction project, you're doing a project which qualify as a capital work in process, right? But you know there is a problem, there is a problem in the project. The question is, there is a problem in the project, will you also stop doing the capitalization of interest cost during such intermediate period, not in its entire. So of course you stop doing interest capitalization if you decide to suspend the project in itself, right? That I'm no longer going to continue with this project. If you no longer want to continue with this project, then you're going to stop capitalization of any interest cost on a go forward basis. Assuming you will continue with the project, however there is a temporary disturbance, and that is where the whole judgment comes into play, that is this temporary disturbance is something which is normal disturbance or something which is abnormal in nature. The moment you were to say that it is something which is abnormal in nature, that is where you got to stop doing the capitalization for that intermediate period, and we'll try and look at it with the help of few example. So capitalization should be suspended during extended period in which active development is suspended. So if you're not doing any construction activity, if it is not moving towards completion and it just lying stand still, then a judgment has to be made that should I stop doing the capitalization of interest cost. So capitalization is not suspended when a substantial technical and administration work is being carried out or temporary delay is necessary part to prepare an asset for its intended use or sale, right? So it's an element of judgment, right? So if you stopped working, I think the one question you would ask is that should I stop, because interest never stops, right? Interest you keep on incurring till the time you repay the debt. So should if I stopped working on the construction project, should I continue to capitalize the interest cost, or should I also stop capitalizing the interest cost? I think that's the question we need to ask. And ordinarily, if you stopped doing the construction and now the asset is just lying, still not being finished and lying is in the midway, or you started and you're not sure, the question is that, is the disruption in that construction activity can be considered as normal, can be considered as part of the construction process. If it is to be considered as normal or to be considered as part of the construction process, then you will continue to capitalize the interest. If it is not to be considered as a normal disruption but an abnormal disruption, it is not to be considered as part of the construction process, then you will stop doing the capitalization of interest cost, right? And we will again try and understand this with the help of an example. Let's look at this scenario, right? Construction suspended due to shifting of equipment from one side to another, which was not planned before. The question is that you were doing construction at site A, right? You now decided to move it to site B. The question here is, and then there's a time which you're losing because of this movement, right? Now this is not adding any value, right? If you would have actually planned it better, you could have done it at site B only, right? So since you're moving now equipment from site A to site B, now that's in a way seems to be like an abnormal wastage, right? Of that in the whole construction process, and hence capitalization of borrowing cost needs to be suspended during this period since development is interrupted. Now let's look at another scenario. When qualifying asset construction is about to complete, there was temporary delay of 20 days on account of some technical reasons, right? And there are many things which happen, that I need to take an approval, I need to get some some diligence being done, some inspections are being done, and hence some of these activities, but those activities are actually necessary, those activities are considered to be necessary for me to kind of launch my project, for me to complete my project, for me to get the certification, etc., etc. Now in this scenario, you will continue to capitalize the interest cost. You will not suspend the capitalization of interest cost, from that perspective. Let's try and understand this with the help of another case study, right? So here in our example, there is a production of genetically modified seeds require an exposure to the right climate for maturing, and therefore they may need to be stored in house for some months awaiting the right climatic conditions. Can the capitalization be suspended in this case? Now, if you look at the fact pattern here, for me to, first of all, it is assumed that this is something which is a qualifying asset. And we are not getting into that debate, right? That this is something which is a qualifying asset. It is assumed, right? Assuming this is a qualifying asset, right? Now, for this asset to actually mature, that I need that climate condition, and that's part of this whole development process of this qualifying asset. It is like, if let's say, if I'm in the business of liquors, right, which is wine or whiskeys or so on and so forth, and we need to store it for a certain period of time to mature, right? Till that point in time, it's actually an inventory which is in process, right? It is not a finished inventory because it cannot be sold in that form. So now any cost which you incur or interest cost which you incur during that period is actually part of the inventory cost. Similarly, in this situation, if this seed, genetically modified seed, it is required that we need to wait for the right climatic condition, and this process is ongoing, then this suggests that you will continue to capitalize the interest cost which has been incurred during this period. So the temporary delay is necessary to prepare the seeds. You will not stop the capitalization of interest during this period as well. Let's look at the scenarios where we may need to stop doing the capitalization, right? So capitalization should cease when substantially all the activities which are necessary to prepare the qualifying asset for its intended use or sale are complete. So when do you stop doing the capitalization? When substantially you've completed the asset, right? The asset is now ready, to be used, ready to use, not put to use, right? Asset is now ready to use. Whether you've been able to put to use or not, that's not relevant. What is relevant is the asset is now ready to be used. In that, you've got all approvals, all inspection, all testing, all of that is in a way is being done, right? So asset is now ready to use. Then you're going to stop doing the subsequent capitalization of interest, because then it is no longer a qualifying asset. It is now an asset which is ready to start generating economic outcomes, right? Activities necessary to prepare the qualifying asset includes routine administrative work, minor modification such as decoration of a property to the purchaser or use specification, etc. So you're going to stop doing. So that means it's all been complete. There's some very minor thing is going on, so there is no more value addition which you are doing. So no longer you're going to start doing. No longer you're going to continue the capitalization. Capitalization of an asset in parts. So many times, we come across situations, and I'm going to again talk it through with another example, that when you are building a large asset, actually there are multiple components of that asset, right? And if there are multiple components of that asset, and you have actually the ability to start commercializing each of these components independent of each other, and you can also commercialize the whole thing when come together or when it is fully developed. Then again, it goes back to the whole question of what is the unit of account is what you are looking at. If these individual components can be considered as separate unit of account, then as these unit of account gets completed, you're going to stop capitalization of interest with reference to that unit of account, right? Otherwise, if you want to look at everything in its entirety as a single unit of account, that means what? That individual components can't work in isolation, and you need to put other things together before they start generating results or economic output. In that case, the whole unit of account will be the entire project, not these individual component. But if your fact pattern suggests that your individual components can actually start generating economic benefit, then the individual components actually becomes a unit of account for the purpose of determination as to when do you start doing the capitalization of interest and when you stop doing the capitalization of interest. The same thing here, each part is capable of being used while construction continues, then substantially all the activities necessary to prepare the part for its intended use or sale are complete. If the each part can be actually be demonstrated to be used in its entirety, and it can generate economic outcome on a standalone basis, and I don't need other parts of my bigger project. Example, a business park comprising several buildings, each of which can be used individually, right? In that case, you identify each unit of account which can be functioned independent of each other, and that becomes your basis of capitalization, or stop doing the capitalization of an interest. So I'm now going to look at this example. A business park comprising several buildings, each of which can be used individually, is an example of a qualifying asset for which each part is capable of being usable while construction continues on other parts. Okay. So essentially, we're just trying to say when it is ready for use, are they integrated? So if they're not integrated, then you keep on capitalizing for those silos and you stop basically, and so once the asset is in production or is ready for use, you stop doing the interest capitalization. Now, if you look at another example, an example of a qualifying asset that needs to be completed, right? Before any part can be used is an industrial plant involving several processes which are carried out in sequence at different parts of the plant within the same site, such as a steel mill. So here, unless the entire plant is complete, you literally can't start the commercial production. Okay, where here, even though you not complete, let's say you're setting up a ride park, right, and you got 5 rides are ready, and and you've got entrance done, exits done, safety is done. People can start coming in and start utilizing, even though you're doing an expansion, which are not interconnected, so to say. So this is started production. So you got to stop capitalization. So you got to understand this, whether or the whole concept here is what's the unit of account, right? What's the unit of account? So at that unit of account level, you will do the interest capitalization and deal with it appropriately. All right. So let's look at this example now. So here, Urban Limited, a company dealing with investment properties, construct properties and lease the same to several tenants. Currently, it has completed construction of an IT technology park with multiple offices on August of 31st, 2019. Now, Urban Limited expects 100% occupancy within a month. Okay. Urban Limited expects 100% occupancy within a month. However, due to decline in macroeconomic situation in the country, there is a fall in demand. Okay. Hence, by March 31st, 2020, only 15% of the offices are rented. So there is a decline in demand and only 15% of the offices are rented, even though they're fully ready. Urban Limited intends to capitalize the borrowing cost until March 31st of 2020, as the offices in the IT Tech Park are yet to be used or occupied. Advise Urban Limited on the appropriateness of the treatment under Ind AS 23. So essentially what we are saying here is that your project is complete, but it is still not occupied. So the question here is that, can I continue to capitalize? The answer is no, you are not allowed to capitalize once the project is ready for you. Okay, once it is ready for use, whether you use it or not doesn't matter. Okay, once the project is ready for use for the purpose for which it is designed, okay, or it is intended in its present condition and location, that means the process of construction is complete. Now once the process of construction is complete, it is no longer a continuing qualifying asset, it stops there. Okay, and you will stop capitalization of interest from that day onward, right? So look at the solution here. As per Ind AS 23, capitalization should cease when substantially all the activities necessary to prepare the asset for its intended use are completed, right? In the current case, substantial activities are completed on August of 31st, 2019, and hence the borrowing cost post this date is not eligible for capitalization under Ind AS 23. All right, let's look at this case study now. So, Sigma Limited, a software company, commenced the construction of a factory building on July 1, 2019. Okay, July 1, remember the dates. Okay, July 1, 2019. The land on which the building is being constructed is regarded as a separate asset and is not part of the qualifying asset and therefore excluded. Given information, we can't do much about it. Now, the construction was completed on June 30, 2020. It's almost a year, right? Now, when the following amounts were incurred on the building: July 1, 2019, 20,000; September, 60,000; March, 1,20,000; June is 20,000. Total is 2,20,000. Okay, is the total spend which I have done. I have more information here. Now, as at June 30, 2020, which is the year end date, Sigma Limited has the below mentioned loan which are outstanding. Specific term loan for 4 years with an outstanding balance of 70,000 as on June 30, 2020. Interest rate is 10%. Okay, on this specific borrowing is INR 6,500 for the year, and an income of 3,000 is earned on investment of unused funds. Okay, so I started spending at the beginning of the year. I've got this specific loan, which is 70,000, and I'm paying interest. The 10% on this specific borrowing is INR 6,500 for the year, and an income of INR 3,000 is earned on investment of unused funds. Awesome. Okay. Now, 10-year secured loan at the rate of 12.5%. Okay, amount outstanding on July 1, 2019 was INR 100,000, which remains unchanged during the year. And then 10% debentures redeemable in 10 years, amount outstanding on was 1,50,000, which remain unchanged during the year. So we have a specific borrowing and we have general borrowings, two types of borrowing. So we got to determine at how much is the total interest which I need to capitalize. Okay, interest is payable at the end of the year on a simple interest basis. Okay, so let's look at the solution on a step-by-step basis. So first I need to determine the capitalization rate, okay, which is applicable in the case of general borrowing. Capitalization rate shall be the weighted average of the borrowing cost applicable to all borrowings of the entity that are outstanding during the period. However, an entity shall exclude from this calculation the borrowing cost applicable to borrowing made specifically for the purpose of obtaining a qualifying asset. Okay, so there are two are here: general borrowing, which is 12.5% into 1 lakh by 2,50,000 plus 10% into 1,50,000 by 2,50,000. So my weighted average rate of borrowing for general borrowing is 11%. Okay, now let's look at how do we compute what we need to capitalize. Okay, so we're going to look at the expenditure, and we had all the dates here when we spent this money. We spent on July 20,000, September 60,000, March 120, and then June 20,000. And we had 70,000 as a specific borrowing, right? So first I'm going to use here, there's nothing which is amount allocated to general borrowing, 0, because it goes against the specific borrowing. Now 60,000 also the only amount. So 70,000 here I have consumed. So 10,000 goes to general borrowing. Okay. And that is outstanding for 9 months. So I apply the 11%, which is 7,500. We'll get to the rate of interest in a while. Similarly, here the entire 120. So we apply the period for which this is weighted, right? 30,000. And then this 20,000 is 0. So effectively 37,500 is the weighted average general kind of against from the general borrowing pool. Okay. So now I'm going to compute the total interest cost. Okay. So I have the specific borrowing, which is fully utilized. Awesome. So I have then the interest cost expense, right? When I look at, on specific borrowing, we paid interest of 6,500. There is an interest income, right? And on the general borrowing, 37,500 into 11%. Okay. So my total is 10,625. And I'm going to also reduce the interest income on specific borrowing, which is 3,000. So my actual interest which is eligible for capitalization here is 7,625, right? So remember, specific borrowing, you capitalize. Now you got to meet all three conditions. That three conditions were met at the beginning of the year, and then so whatever interest cost I paid, interest income, I'm going to offset the two, and then I'm going to look at the general borrowing, the weighted average rate of general borrowing. I'm going to apply it here for the period this has been spent, and that number get to 7,625. Here this is 37,500 at the rate of 11%. But remember the steps, remember the way to get to the right answer. Let's look at this examination question, which was asked in November 2019. For 8 marks, this was again on the question of determination of the capitalization rate, right? So an entity construct a new office building commencing on 1st of September 2018. Again, remember all the dates. Now, these dates are very, very important, right? Which continues till 31st of December. So it started on 1st December, it continues till 31st of December, and it is expected to go beyond a year. Why this information is important and necessary? It means that it is a qualifying asset. It's going to take more than 12 months. Directly attributable expenditure at the beginning of the month on this asset. Beginning of the month means 1st of September, right? INR 2 lakh in September and INR 4 lakh in each of the month of October to December. So we are incurring this cost at the beginning of each of these months, right? The entity has not taken any specific borrowing. I have not taken any specific borrowing to finance the construction of the building, but has incurred finance cost on its general borrowing during the construction period. Now, during the year, the entity had issued 9% debentures with a face value of INR 30 lakh and had an overdraft of INR 4 lakh, which increased to INR 8 lakhs in December of 2018. So I had 9% debenture with a face value of INR 30 lakh and an overdraft of INR 4 lakh, which increased to INR 8 lakh in December of 2018. Interest was paid on the overdraft at the rate of 12% until 1st of October 2018, and then the rate was increased to 15%, right? So there are multiple information. So I had a 9% debenture with a face value of INR 30 lakh, and I have an overdraft of INR 4 lakh, which increased to 8 lakh in December 18, right? Interest was paid on overdraft at the rate of 12% until 1st of October, and then the rate was increased to 15%. So multiple types of liabilities which I have, debt type of liability like overdraft, like this debentures, and then the interest rate is also different, and then the interest rate changed during the period as well, right? So it's important for us to determine the capitalization rate. The question is calculate the capitalization rate for computation of borrowing cost in accordance with Ind AS 23. And this is only a question on general borrowing. I don't have specific borrowing, right? So how much is the total money which I have spent, right? The total money which I spent was 2 lakh in September and then 4 lakh in the month of October, November and December each. So total money which I spent was close to 14 lakh, right? But that's not the question here, right? The question here is on the amount which you have spent, right? And then you have these debt which are outstanding. So what is the rate at which you can capitalize interest, right, on this capital expenditure? And then you did, and you don't need to determine the how much is the total interest which I need to capitalize. I only need to determine the capitalization rate. So how do I now determine the capitalization rate is something which we need to do as a step-by-step approach. And remember, how do I determine this? I need to determine this with reference to my interest outflow, right? And weighted it by the time, for which that such loan is outstanding. Time factor by which such loan is, amount, and the time for which such loan is outstanding. So I need to determine the weighted average of my interest cost, from that perspective. So you look at the capitalization rate, weighted average of general borrowing, which is 30 lakh. That's simple because that is outstanding for the entire period. 30 lakh into 12 by 12 plus 4 lakhs, right? 4 lakh into 11 by 12, because what I've done, I've actually borrowed more in the month of December. So this 4 lakh was for the 11 months which was outstanding, and this 8 lakh was outstanding for 1 month. So my total average outstanding, right, is 34 lakh 33,334 weighted average outstanding during the period, right? And then how much is the interest I paid, right? Now I need to determine how much is the interest I'm going to pay on this. The total is 30 lakh. I'm going to pay 9%, which is 2,70,000. On 4 lakh, I paid at the rate of 12%, which is 36,000. Now this interest rate changes. Now that's the important information which you don't need to miss here, right? Because the interest rate changed at the end of September. From the month of October, I started paying 15%, but the amount is still the same, right? For 2 months, I paid at the rate of 10%, which is 10,000. Or for 1 month, when the amount also increased, right, I again paid the rate of 15%. The outflow is 10,000. So total interest expense which I had during the period for the total outstanding is 3,26,000. So now how am I going to determine my capitalization rate? Is very simple to say 3,26,000 divided by the average borrowing, weighted average of general borrowing, which is 3,26,000 divided by 34,33,334, and that will gives me 9.5% is my capitalization rate. All right. So now I hope you understood that how do you determine the capitalization rate, right? So I need to look at, if you want to do it very simply, look at your total interest cost based on the available information. You got to then time factor weight your outstanding borrowings, right? And then divide the total interest cost with your weighted average of borrowing. That will give you your capitalization rate, which is 9.5% in this example. So we've talked about at length, right, this entire standard in terms of how do you assess the qualifying asset, something which takes 12 months or more, though this is an area of judgment. And then you look at, what are different components of interest in itself, something, let's say, what is a borrowing cost in itself. If you have a debt which is outstanding on the left hand side of your balance sheet, you're incurring interest cost on your lease liability or any other interest type of cost which you are there. And then we talked about, do you have specific borrowing, do you have general borrowing? We also talked about nuances if you have foreign currency borrowing. So for general borrowing, it is slightly more complex. For specific borrowing, it's slightly easy for you to determine the appropriate amount of interest which needs to be capitalized. We also talked about it's not an accounting policy choice, it's a mandatory requirement. And we tried to also help you understand that the whole concept of that this money is fungible. The moment, let's say, you borrowed money against plant A, the plant A construction is complete, and if the debt is still outstanding in your balance sheet, then that borrowing which you had actually borrowed for plant A and you started doing construction of plant B, then this borrowing which you've done for plant A, that actually becomes part of general borrowing, for plant B. And anything which you borrowed specifically for plant B, that becomes a specific borrowing for plant B. You are not supposed to do an argument to say because this money was actually borrowed for plant A and plant A has now completed the construction, the interest cost which I'm incurring for the borrowing which I borrowed against plant A, that is no longer eligible for capitalization. That's not the right way of looking at it, because you started another construction project. Since you started another construction project, the simple argument is that if you would have borrowed money, right, for that plant B and actually would have repaid the loan on plant A, you could have achieved the same economic outcome, right? So you decided actually not to borrow more money, but use the money which is already available to you, and or not to repay that money which you borrowed against plant A if you are doing another kind of a capex. So if you have, so in summary, you got to look at it very simply to say, if you have a qualifying asset on the right hand side of your balance sheet, and if you have a debt on the left hand side of your balance sheet on which you're incurring interest expense, there is an interest cost which is being charged in your profit and loss account, or which is likely to be charged to your profit and loss account. You've got to evaluate that interest cost to say that whether this interest cost is eligible for capitalization under the principle of Ind AS 23. And if it is a specific borrowing, it has to be capitalized. If there is a qualifying asset, any interest income which you earned during the period, that needs to be knocked off. If there's a general borrowing, then you figure out the weighted average borrowing period, you determine the total cost which you have incurred on the borrowing, and then you determine your capitalization rate. You marry this capitalization rate to the different dates of expenditure which you have incurred, and then you appropriately determine the amount of interest cost which you need to capitalize. So moving forward to talk to you about some of these disclosures. So entity shall disclose, 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 and disclose the amount of borrowing cost capitalized during the period and the capitalization rate which is being used to determine the amount of borrowing cost which is eligible for capitalization. So to recap what we've talked about, the commencement of the capitalization, which is expenditure for the asset has been incurred, the borrowing cost has been incurred, and the activities to prepare the asset has already commenced. When you stop doing the capitalization of the interest cost, when substantially all necessary activities to prepare the asset are complete, you may also need to stop doing the capitalization of the interest in the intermediate period if you believe that there is a disturbance, there's a disruption which is abnormal in nature, if there's a disruption in the construction activity which is considered to be abnormal in nature, like the example we talked about, that you got to move now asset from plant A to plant B, and that period was completely unnecessary, and hence it's not adding any value, then you need to stop capitalization of your interest cost during that period, right? However, if let's say you were doing some technical testing, you're waiting for the right climatic conditions, etc., which are in a way are not considered to be abnormal in nature for that type of construction project or that type of capital work in progress which is being undertaken, then you will continue to do the interest capitalization till the time the project is actually complete, right? And that's a very, very important distinction is what you need to remember. Quickly, in a way, talking about some of the differences between Ind AS 23 and Indian GAAP. Again, there are not a whole lot of difference in a way which exist between existing Indian GAAP or Ind AS 23. Ind AS 23, in a way, scopes out the qualifying assets are measured at fair value, inventories which are produced in large quantities. There is no such scope exclusion under the old Indian GAAP. Components of borrowing cost, it refers to effective interest rate. There is no such reference given in the Indian GAAP, from that perspective. And then the borrowing of parent and subsidiaries for computation of weighted average. Now that's an interesting, in a way, example, that in the consolidated financial statement, it is also possible for you to consolidate some of the borrowings made by the parent but actually deployed by the subsidiary for the purpose of capex. That's possible in the framework of Ind AS 23. There's no such detailed references made under accounting standard you know, under Indian gap, you know, from that perspective. So Ind AS 23 specifically provides that in some circumstances it is appropriate to include all borrowings of the parent and its subsidiaries when computing the weighted average of borrowing cost. Because many times what happens, let's say the parent has actually borrowed money and they have actually funded the subsidiary by way of an equity contribution, right? And then subsidiary is carrying out the capital work in progress, right, or the capex project. So in the subsidiary standalone financial statement, if you see, there is no loan. Since there is no loan or no interest cost, there is no question of capitalization. But when you look at the consolidated financial statement, on the right hand side of my balance sheet, there is a qualifying asset, which is the construction work in progress. On the left hand side of my balance sheet, there is a debt which is outstanding. So in the consolidated financial statement, this interest is actually eligible for capitalization. And that's what you know, you need to understand and keep in mind, that the Ind AS looks at it more and more from a balance sheet perspective. Ind AS is more focused you know, as a unit of account. So if consolidated financial statement is a unit of account in this case, then you got to capitalize interest at the consolidated financial statement level, even though you may not be able to capitalize interest at the standalone financial statement level, you know, from that perspective. So I hope this has helped you to be clear on some of the nuances around Ind AS 23. Of course, we will continue on this with some more examples, more you know, practice session for you to look at more questions, which again my colleague is going to take you through you know, in a while. Thank you very much.